When investors look for a top-flight dividend ETF to add to their portfolio, they usually start with a list of roughly a dozen commonly used funds. That list typically includes ETFs like VIG, VYM, and VOO. Other dividend ETFs exist, but the majority of analysis pieces tend to concentrate on this particular group. I've done it myself. But that doesn't mean they're the only ETFs worthy of your attention. In today's video, I'll show you and John 3 of the best ETFs you can invest in without worrying. I'll show you how they stack up and what their strategies are. I'll show you how much you and John can earn from a $100,000 investment in each of these ETFs alone. Fun fact, one of them has the potential to cross a $20 million portfolio return. And in the end, I'll show you how you can combine these ETFs to reduce risk and still manage excellent annual dividends and capital appreciation. Before jumping straight into discussing the ETFs, I want to outline my criteria for selecting these funds. When I choose exchange-traded funds, ETFs, for my investment portfolio, I have some rules. First, the ETFs should match what we want to do with our money, whether focused on income generation, capital appreciation, or a combination of both. I want the ETFs to have a mix of different kinds of investments, so we don't put all our eggs in one basket. Third, I like ETFs that don't cost too much, so that we can keep more of our money. Lastly, stability is important, which can be assessed by looking at how well the ETFs have performed in the past to see if they're good at making money. With these criteria in mind, let's begin by discussing the first ETF for today, Schwab U.S. Dividend Equity ETF, known by the ticker symbol SCHD. Launched in 2011, SCHD is a passively managed ETF designed to offer investors exposure to high-quality dividend-paying stocks in the U.S. market. With assets totaling over $52 billion, this ETF is one of the largest ETFs attempting to match the large-cap value segment of the U.S. equity market. Despite its size, it maintains a massively low expense ratio of just 0.06%, making it an attractive option for cost-conscious investors seeking reliable income and long-term growth potential. SCHD's stock selection process is based on a set of stringent criteria aimed at identifying financially robust companies with a solid track record of dividend payments. The ETF's holdings are filtered based on the following criteria. 1. Minimum 10 consecutive years of dividend payments. 2. Minimum float-adjusted market cap of $500 million. And 3. Minimum 3-month average daily volume of trading of $2 million. Once qualified, stocks are further ranked based on their dividend yield, 5-year dividend growth rate, financial health, and return on equity. This comprehensive evaluation process ensures that SCHD's holdings include companies with strong financial fundamentals and a consistent increase in shareholder value through consistent dividend payouts. Something we'll see in the upcoming chapter is the projection of how much it would return from a $100,000 investment. And in the end, I'll show you an ETF that has the potential to reach a valuation of $200 million with a one-time investment of $100,000. Back to SCHD. This ETF portfolio consists of 102 holdings, with the top 10 holdings making up approximately 41.84% of the fund. These holdings include well-known names such as AbbVie, Chevron, PepsiCo, Pfizer, Coca-Cola, Verizon, and Texas Instruments, among others. These companies are industry giants renowned for their stability, profitability, and ability to generate steady cash flows, making them reliable sources of dividend income for investors. Not every ETF or stock always does well, including SCHD. Even though SCHD didn't perform well last year, it's important to understand why. Sometimes, investors make quick decisions based on recent events or focus too much on losses instead of gains. Knowing about these biases can help investors stick to their long-term plans and avoid making hasty choices. Even though SCHD faced some problems recently, it still has strong points that make it a good choice for long-term investors. So what does this mean for a $100,000 investment in the long run? Let's run the numbers. SCHD has a current dividend yield of 3.38%, backed by a strong 10-year average dividend growth rate of 10.87% and a solid 8% share price appreciation average over the past 10 years. Based on these metrics, if John invests $100,000 in this ETF, after 1 year, his investment is projected to reach $111,380. After 10 years, the investment is expected to triple to $306,484. Yet, it's the dividend yield of SCHD that truly shines over time. After 20 years, John's investment is anticipated to grow to $1,050,609. And extending to 30 years, his initial investment has the potential to grow to $4,170,308. Notably, he'll receive a massive $276,825 in dividends annually, approximately $23,069 per month. In total, this ETF has the potential to add $4,070,308 to his initial investment, with $2,251,669 coming from capital appreciation, while an impressive $1,818,639 came from reinvested dividends, showcasing the power of consistent dividend reinvestment strategies. Now, if you think this is a good return, wait until you see the next two ETFs on the list. One of them has the potential to reach an over $20 million valuation. In the end, I'll show you with a portfolio how you can double the SCHD return and get over $40,000 in annual dividends. Next up, we have the Invesco QQQ Trust with the ticker symbol QQQ. This exchange-traded fund, ETF, offers investors exposure to a diversified portfolio of stocks. Like SCHD, this ETF also uses a passive management approach. Unlike actively managed funds, which rely on financial experts to hand-pick investments, QQQ aims to replicate the performance of its underlying index, the NASDAQ 100. This strategy helps keep fees low, around 0.2%. This is higher than SCHD, but once you see the historic performance and the return that I'll show you in the end, it all makes sense. The NASDAQ 100 index includes the top 100 companies listed on the NASDAQ Stock Exchange, predominantly in the technology and growth sectors. These companies represent some of the most innovative and dynamic players in the market, including industry giants like Apple, Microsoft, Amazon, and Alphabet. QQQ's portfolio also includes top-performing stocks in semiconductors, healthcare, and software sectors, providing investors with exposure to diverse growth opportunities. As for its historic performance, QQQ has a remarkable track record of delivering strong returns over the long term. With an average annual return of 10% over the past 3 years, 22.4% over the last 5 years, and an over 17% return over the past decade, QQQ has outpaced the broader market, including the S&P 500 index. Its consistent performance has solidified its position as one of the premier ETFs, managing a substantial $259 billion in assets. While QQQ's historic performance is impressive, investors must consider its valuation, especially in the current market environment. With some of its top holdings trading at high multiples of earnings and book value, there are concerns about overvaluation. Buying QQQ at peak prices could lead to prolonged periods of waiting for returns, reminiscent of historical market downturns. Therefore, cautious consideration of entry points is advised, balancing potential returns with valuation risks. Now, despite valuation concerns, Wall Street analysts maintain a generally positive outlook on QQQ, with a majority rating it as a moderate buy. Analysts foresee potential upside for the QQQ stock price, projecting an approximately 11.89% increase from current levels. This sentiment reflects confidence in QQQ's underlying assets and their long-term growth prospects, despite short-term market fluctuations. So, Wall Street analysts think this is a good ETF, and history suggests the same, but what does the future look like? Let's find out. QQQ has a current dividend yield of 0.55%, not the highest, but it has a good dividend growth rate of 9.93%. But this ETF is about capital appreciation, which can be seen from its average share price growth over the years of about 17.7%. Based on these metrics for QQQ, John's investment after the first year is expected to reach $118,250. After a decade, the investment is set to more than quadruple to $527,504. After 20 years, John's investment is forecasted to reach $2,731,723. Give it 10 more years, and in 30 years, his initial investment has the potential to grow to an impressive $14,030,517, paying $6,277 in annual dividends. In total, this ETF has the potential to add $13,930,517 to its initial investment, with $13,858,290 attributed to the growth of QQQ stock, while $72,227 came from dividends. These returns are extremely good, but can our first-ranked ETF do even better than that? Let's find out. We have the Vanguard Information Technology ETF, known by the ticker symbol VGT. Managed by Vanguard, this is one of the leading names in the investment management industry. Our first ETF, SCHD, is dividend-focused. The second, QQQ, is inclined towards tracking and outperforming the index, while VGT is solely here to make your investment grow. That is, this ETF is all about capital appreciation, something you'll see when, in the end, we run the future projections for this ETF. In fact, it's so growth-focused that it only invests in the tech sector. VGT sticks to a strict definition of information technology. For example, it doesn't invest in Amazon, viewing it as a retail company, nor in Google or Meta, which it categorizes as a communications company. This targeted approach aims to provide investors with exposure to the core of the tech sector, emphasizing innovation and growth potential. While VGT's expense ratio of 0.1% is double that of the average Vanguard ETF, it remains significantly lower than the average for similar technology-focused funds. Unlike some broader ETFs, such as Invesco QQQ, which includes non-tech companies, VGT remains true to its tech-focused mandate. This exclusive concentration on the tech sector makes VGT an attractive option for investors who believe in the long-term growth prospects of technology companies. Some people think you can get the same returns by owning VGT's top stocks individually, but VGT's performance shows that's not true. It focuses on a few key stocks, which helps it benefit from the great performance of new tech companies, even if it's mostly invested in a few big ones. This flexibility lets VGT do better than the overall market. While quantitative ratings should not be the sole basis for investment decisions, VGT holds a favorable strong buy rating from Seeking Alpha with strong scores across various categories. So, does this ETF have what it takes to cross the QQQ forecast? Let's find out. VGT has a current dividend yield of 0.7%, not the highest, but it does have one of the strongest dividend growth rates of 14.36% and an even better average share price appreciation of 19.13%. In the first year, John's $100,000 investment in VGT is projected to reach $119,830. After 10 years, the same investment is projected to multiply six-fold to $603,732. After 20 years, John's investment is forecasted to balloon to $3,578,687. Pushing even further to 30 years, his initial investment has the potential to skyrocket to a remarkable $20,975,390. Additionally, he'll receive $29,827 in dividends annually, translating to about $2,486 monthly. In total, this ETF has the potential to add $20,875,390 to his initial investment, with $20,632,836 coming from the growth of VGT, while $242,527 came from the dividends. Okay, now that you've seen the return from the three ETFs, here comes the portfolio of all three. Investing in these ETFs is a great opportunity, but like any investment, ETFs have risks, and you cannot put all the eggs in one basket. To minimize these risks, diversifying your investment is crucial. That's where the portfolio comes in. This well-diversified trio can potentially achieve diversification across different investment styles. This means your investment is not solely reliant on the success of any single sector or company. QQQ offers the potential for significant capital appreciation, while VGT prioritizes the cutting edge of technology. Meanwhile, SCHD strikes a balance between growth and income with a potential bias towards stability. If you choose the ETFs mentioned above and invest an equal amount in each, you can calculate some key metrics to assess your portfolio's performance. All you have to do is add the respective yield percentages and divide by 3, and you'll have your portfolio's average dividend yield, dividend growth, and annual growth. For our portfolio of these three ETFs, we get an average current dividend yield of 1.54%. A strong dividend growth of 11.72%, and an average annual growth of 14.94%. Let's say John invests $100,000 in this portfolio. After a year, this investment will be valued at $116,480. In 10 years, it's projected to quadruple to $451,710. Moving on to 20 years, this portfolio is projected to reach $1,975,972. And at the 30-year mark, John's initial investment of $100,000 is projected to reach an impressive $8,445,497, paying an annual dividend of $43,572 or approximately $3,631 monthly. In total, this portfolio significantly grows his investment by $8,345,497, which includes $7,951,990 from the rise in portfolio value and $393,507 from dividends. For a prime entry into dividend stocks, watch the video on the screen to discover the top 52-week low dividend stocks to invest in right now.